Good morning, it's Tuesday, May 12th. So much has changed since my last market update video. Let's start first with the coronavirus. For the month of April, we went from a 15% spread rate to a 3% spread rate, which is down about 80%. Still not where we would like to be, but much improved in just 1 month. We also started April with about 120,000 tests per day, and we ended April with 250,000 tests given per day. Again, not where we'd like to be, but certainly a drastic improvement in 1 month. Positive cases are now less than 10% of those tests, and new cases are about 25,000 per day. Both of these data points are drastically lower than where we could have been based on the assumptions that we were hearing a month ago. We also need to look at the economy. Job loss has been drastic, with millions of Americans losing their job each week. It has put us into a recession, and with a bad first quarter already behind us, we have an absolute dismal second quarter that we're in now. But the news lately is coming in less bad. Weekly layoffs are actually starting to trend down. So does this mean that the damage has been done and this is as bad as it gets? I don't think we can really tell at this time, but we are certainly starting to see better trends. And let's not forget the federal stimulus. It wasn't even signed into law until March 27th, which was just 6 weeks ago. We are now seeing the stimulus checks arrive in people's mailboxes, with more to come, and the paycheck protection loans are starting to show up in business bank accounts, with more to come, and expanded unemployment is paying millions of Americans that lost their paycheck each week. These are certainly good items in the short run. And yes, we have gotten a question about whether this much stimulus can cause inflation. There's certainly an academic argument about policy-driven inflation. The argument means that inflation then would have been inevitable since 2009, and we haven't even seen it yet. I mentioned it more than 10 years ago in our 2010 annual market outlook that inflation was not inevitable. And I think you could look at Japan, which has been in the grip of runaway inflation for over 3 decades now, or the European Union that also has policy-driven reasons to have inflation, and neither one of those have seen inflation. Again, no inflation in those areas. There are really just 2 factors that cause inflation: supply and demand. The argument is that this stimulus will cause a demand spike. Well, the reason for the stimulus is due to the lack of demand. So we actually need demand to recover first, and then we would need the government to continue to add stimulus in order to spark inflation. Even if we do, it's certainly too early to worry about it. The other side of inflation is the supply shock. This is actually a little more realistic. Right now, for example, the meat industry is seeing a supply shock. But we don't see that as something that's systemic. There's certainly been a drop in supply, and in some places supply has halted, but that's due to the lack of demand and the pandemic lockdown versus systemic supply issues. So again, nothing to worry about now. Just this week, the IMF came out with their global recession forecast. It's 3% recession for 2020, which is a major revision. They had actually planned for 3.2% growth this year, so a 6.2% shift. They also have indicated their 2021 GDP estimate, which is 5.8%, a drastic rebound. Kind of thinking about it, industrialized countries would be 4.5%, and emerging markets would be 5.8%. And as a reference point to the 3% drop this year and a 5.8% recovery next, here's the last 3 years. In 2017, we were at 3.7. In 2018, we were at 3.6, and last year we were at 2.9%. So the IMF clearly assumes the pandemic will fade pretty drastically in the second half of 2020. And the trends are shifting, and so they're starting to mount evidence that April might actually have been the bottom for the economy. We know opening the economy is a necessity. Those risks, which should not be minimalized, will remain. We know that people need jobs, and we need to try to save as many businesses as we can in this country. Pathfinder, what reopening the economy means is that we can begin to learn a lot. What does this reopening look like? Which businesses will reopen? Will consumers go out and spend money, and where will they spend money? How will people behave? And certainly, what is the risk of a second wave of infections? Any way you look at it, there are still many risks out there, but reopening is a necessary step. So far, what's going on now is signaling great confidence, which leads me to talk about the financial markets. Markets think everything is going to be fine, and they have priced in a V-shaped recovery, which is a sharp rebound. It means that in a couple quarters, everyone will be back, everybody will be working again, and everybody will be spending again. And that sounds a little overly optimistic to us, but that's why we are continually waiting on the data. If May does go well, then the assumption that the markets have right now will be on firmer ground. As one of our past emails mentioned, we felt like this is the end of the beginning of this crisis. A month ago, we didn't know what would happen. Would we have a viral contamination explosion like we heard predicted often? Would we have an economic depression, which we also heard predicted? Neither of those have happened so far, and the track we are going on now gives us hope that the virus can be contained in the next several months and that businesses can reopen successfully. Most importantly, though, we are just now starting to get more data that will give us ways to look at how this can fully reopen and understand this crisis. The biggest risk remains is the second wave of infections. The good news is that we made tremendous progress in this last 1 month, and we're looking forward instead of being paralyzed like we were a month ago. We're now in a position to find out how to reopen, and that will be the main focus that the markets are looking for over the next several weeks. So that's going to be the key area for the markets. We had a drastic and sharp sell-off, and it did bottom on March 23rd. That has quickly turned around. We certainly aren't back to where we were before the market started going down, but we are more than 35% recovery off the bottom. And no asset classes were able to be unscathed. Stocks, bonds, real estate, commodities, everything got hurt. Bonds had a liquidity crunch and a credit scare, and the Federal Reserve stepped in. They're actually buying junk bonds now, which has never been done before. So the policy response from the Fed has been tremendous and given the bond market a lot of stability. Stock sectors such as energy, hospitality, and leisure, and of course transportation have suffered the worst. Financials have also been hurt badly during the last couple months. Other areas such as technology and consumer staples have actually held up very well. And you probably saw the news this past week that the NASDAQ actually crossed into positive territory for the year. I mentioned that the top 5 stocks in the S&P 500 are, I believe, over 20% of the weighting of the S&P 500. And those are Amazon, Google, Microsoft, Facebook, and Apple. And so just those 5 stocks are making the S&P 500 come back quite a bit as well too, whereas again, other area stocks are still down drastically. It is extremely difficult to try to determine the price of a stock now because we don't know what their earnings are, and basically very few companies gave guidance on what they expected for this quarter. So we're kind of sitting on our hands waiting for July data to come through, which is something I said we'd have to do. And we are still expecting the worst news to come from the quarter that we're in, which will be released in July. There's a very good chance that we will not retest those previous lows, meaning that we'll not see the market go back to where we were in late March. However, nothing's guaranteed. It's hard for us to believe we can keep this same rally going from here that we've had in the last several weeks. But again, the market has a way of kind of surprising us all. So it's hard to understand, certainly when nothing is normal or normalized. And we do expect volatility to continue, particularly the next 2 quarters. We're still navigating these uncertain times, and the number one question is, will we see a negative shift in the pandemic trend? And if that happens, is it going to derail our recovery? Other important questions are whether the market can remain optimistic when more bad news is certainly on its way, or will we have a correction, a shorter term correction? And obviously, can the markets really keep their eye on next year and sort of forget about this year? And those are things that we're going to want to see the strength of the market. And as we mentioned earlier, in all our communications since this started, is we do too think this too shall pass. We're not confident enough yet to tell you that we're convinced that we're going to have this sharp V-shaped recovery versus a U-shaped recovery. but we do certainly believe in a recovery. We'll keep focused on our diversified strategies, which prevail over time. And if you have any questions or anything, let us know. We hope you and your loved ones are safe and certainly making the most of these strange days. And thank you very much.